Welcome to This Explainer. Look, we literally hear it every single day. The AI revolution is here. But while the spotlight is constantly shining on the usual software and chip design suspects, the Microsofts and NVIDIAs of the world, there is an entire physical world being built right beneath our feet. So today, we're going to look past those obvious names. We're uncovering the hidden US giants that are actually building the concrete, the servers, and the cables of the AI boom. Here's our blueprint for today. We'll start with the AI infrastructure megatrend, then look at Dell as the server powerhouse and Micron's memory supercycle. After that, we'll cover power and connectivity essentials, dive into dividends and cooling innovators, and finally wrap up with timing the AI build-out. Let's jump right in. All right, part 1, the AI infrastructure megatrend. Before we even start looking at specific stocks, we absolutely have to understand the massive, unprecedented scale of this gold rush. Hyperscalers like Google, Amazon, and Meta, they aren't just buying software licenses. They are pouring hundreds of billions of dollars into physical infrastructure. Just to put that into perspective for you, a single AI data center can consume as much power as an entire small city. It's wild. This is a massive, tangible build-out happening right now across the country. And the projections are staggering. Estimates suggest that AI-related capital expenditures, meaning the physical assets being bought and built, could actually triple or more in the coming years. This creates an incredible multi-year runway for what we call picks and shovels companies. These are the businesses supplying the essential physical tools for this digital gold rush. Moving to part 2, Dell, the server powerhouse. Let's start building out our data center with the compute layer. Now, I know what you might be thinking. Dell? Isn't that just the traditional PC maker you bought your clunky college laptop from? Well, scratch that. That is an entirely outdated narrative. The reality today is that Dell has completely transformed into an absolute titan of AI-optimized servers. They're deploying private clouds and enterprise AI, building themselves a massive high-margin moat. And the numbers completely validate this shift. Dell just posted a record $113.5 billion in overall revenue for fiscal 2026. But the really crazy part? Look at their AI-optimized server segment. That area saw dramatic growth, peaking at $9 billion in just one quarter alone. Some reports are showing quarterly growth of over 300% for these servers. They are closing massive orders and heading into their next fiscal year with a huge AI backlog. So, what does this all mean for us as investors? Well, Dell's FY27 guidance anticipates AI servers approaching a staggering $50 billion annually. Now, sure, this recent success has pushed their forward price-to-earnings ratio up into the 30s, but they also just recently raised their dividend by 20%, bringing the yield to about 0.5%. It gives you direct, high-margin exposure to this server build-out with a very proven path to growth. Let's move on to part 3, Micron and the memory supercycle. We're moving from the servers that process the data down to the memory that actually feeds it. Think of it like the brain's fuel. Here we have Micron technology. Now, to really understand Micron, you have to understand high bandwidth memory, or HBM. AI has an insatiable appetite for data. You literally cannot train complex models without massive memory capacity. HBM is an absolutely essential piece of infrastructure, and right now, hyperscaler demand is vastly outstripping the available supply. This intense demand has driven Micron's one-year returns past 700% in certain periods. No way, right? But it's true. We are seeing revenue guidance hitting levels that people once thought were impossible for a memory company, with peak quarterly revenue guidance approaching an incredible $33 billion. And here is their true competitive advantage: scarcity. Key HBM supply is entirely sold out for 2026. Think about that for a second. When capacity is completely sold out, pricing remains incredibly firm, which is driving their gross margins up into the 80% range. When you factor in this massive earnings momentum, Micron's forward PE, which sits in the 20s to 40s, is often cheaper than its software or GPU peers. It's a really compelling risk-to-reward scenario. All right, part 4, power and connectivity essentials. Next, we need to examine the nervous system of the AI data center. First up is ON Semiconductor. As we mentioned, AI data centers draw an immense amount of electricity, and ON provides the crucial power and sensing solutions to manage all of that efficiently. What's fantastic about them is the diversification. They are essentially a picks and shovels play for both the AI and the electric vehicle supercycles. This dual tailwind is leading to forecasted earnings growth of over 30% per year. Then we have Astera Labs handling the massive data traffic jams. Look, as AI models scale up, they demand ever faster data movement to prevent networking bottlenecks. Astera provides the critical connectivity hardware, stuff like advanced PCI and CXL retimers, that literally make these data clusters faster. Because this hardware is so incredibly essential, Astera has seen triple-digit percentage revenue growth in key periods.
Which brings us to part 5, dividends and cooling innovators.
Keeping these massive machines running can actually generate some serious income for investors along the way. Broadcom is a huge standout here as an absolute dividend powerhouse. Their custom AI accelerators push their AI revenue up over 100% year over year, and they're guiding for over $45 billion in AI revenue for FY26. But what makes Broadcom truly special is how they pair massive 77% gross margins with a dividend that they've raised for over 15 consecutive years. Meanwhile, you simply cannot run billions of dollars of compute without elite cooling. These next-generation AI chips get incredibly hot. Vertiv provides the critical liquid cooling and power infrastructure that physically stops these billion-dollar systems from melting down. Backed by a massive backlog and 20 to 30% plus revenue growth, they are a vital infrastructure play directly tied to those rising data center temperatures.
And finally, part 6, timing the AI build-out.
So how do we synthesize all these physical layers into an actionable strategy today? Well, there isn't just one single way to invest in this space. Whether you want the established scale and dividend of Dell, the aggressive cycle growth of Micron, the high beta connectivity growth of Astera Labs, or the income safety net of Broadcom, these stocks offer incredibly diverse entry points into the exact same multi-hundred billion-dollar megatrend. The ultimate verdict here: we are still in the very early innings of this AI build-out. Now, sure, cyclical risks and capex fluctuations always exist in tech, we know that. But unlike pure hype stocks, the valuations of these infrastructure companies are supported by real fundamentals, proven demand, and massive visibility into their backlogs. By focusing on quality management, utilizing dollar cost averaging, and capturing dividends, this becomes a highly compelling megatrend to follow. We'd explored the physical blueprint of the AI revolution today, everything from the servers crunching the data down to the liquid cooling preventing a total meltdown. So I'll leave you with this final thought to consider for your own research and portfolio. Are these hidden infrastructure giants on your radar yet? Thanks for joining me for this explainer, and keep learning.